Hi, everybody. It's Jessica Stone at Stansberry Research, and I'm joined by Matt Weinschenk, a guy I go to for a lot of education and explanation when it comes to the stock market and the world of finance. We are hearing a lot about valuations, which we've already covered, and hearing that valuations on the stock market are the highest they've been since the dot-com bubble. So I think that begs the question, what is a stock market bubble?
What is a bubble? So bubble, I feel, has become an overused term. People use it when they think things are just a little too richly priced, or they think things have to fall. So people throw out bubble a lot. I think the true meaning of bubble and sort of where it started is when things have completely divorced from any sort of fundamental basis for their valuation. So people are buying in, new people are joining markets that they haven't traded before. They're telling their friends it's so easy and prices are just moving so quickly. But the real key is that there's no sort of future that can justify what those valuations are. So if you talk about the market today, is it richly priced? I call it 24 times forward earnings. Yes, that's a high price, but it's not a bubble. But prices could come down, but there's no sort of crazy frenzy that's going on like things were happening in the dot-com bubble or some earlier ones.
Yeah, so you talk about the dot-com bubble. That's the sort of closest bubble we talk about, right? But what are some other examples of when our economy, and specifically our stock market in the US, has experienced a bubble?
Yeah, so I can give you some good examples. Obviously, there's a dot-com bubble. The housing bubble was probably a pretty legit bubble.
And that's what we just had. That's the most recent bubble that led to the crisis in 2007. That's what you're talking about?
Yes, exactly. And then there's smaller scale bubbles, and I think this might help show you the difference. So let me tell you what wasn't a bubble. Think about when Uber's stock was coming out, and it was priced at about $80 billion was the market cap. And they made absolutely no money, and I think they had about 12 billion in sales. So people said, look, this is a bubble. There's a unicorn bubble. But if you think about it, there was a potential for Uber to be the big transportation stock that transported everything, and it could have been $1 trillion company. And maybe you put a 10% chance on that happening. So if that's the case, Uber could be worth $100 billion. Now, that was too high of a price. That doesn't look like it's going to happen, but there was some future where that was possible. So a more recent bubble was on cannabis stocks, right? The entire future potential for the cannabis market, it was around 50 to 70 billion. So the point there is that these stocks that had no earnings and almost no revenue were trading at a price that reflected the whole future of the mature market. So that's a situation where you would say, look, the future cannot match what these stocks are pricing in. And of course they fell 80%, and now they look a lot more attractive.
Yeah, well, it helps when you get Uncle Sam to designate you medically necessary, excuse me.
Sure does.
So what do you do as an investor when you see a bubble? What should you be thinking about? And should you just get out?
Sure. So I can give you two viewpoints on this. George Soros, who's one of the greatest traders and investors of all time, says he loves to see a bubble and he loves to jump in and add fuel to the fire, right? Because he knows he's smart enough to figure out when to get out. Now, Alan Greenspan, an economist, he's in his definition of bubble, he says part of it being a bubble is that you do not know when it's going to deflate and you can't tell. So there's two sides of the story. You think you're a master trader, you could jump in and ride it. But for most investors, you cannot figure this out. I cannot figure this out. The prices are divorced from any fundamentals, like I said. So there's no turning point. It's just investor psychology. So if you're a conservative investor, growing your wealth for retirement, you should just avoid these bubbles. If you have to speculate, if you have to make a trade, make it small, because when these things turn, they turn really fast, and you're probably not going to get out right at the top.
When you say avoid a bubble, you mean when you see things becoming overvalued, get out. So that would be like if you as an investor think right now stocks are overvalued, leave the stock?
Well, I think as a long-term investor, you shouldn't try to call bubbles, right? You should probably be staying in the stock market. There are other times, maybe something like Bitcoin or marijuana stocks, or there's these smaller bubbles, if you wanted to flip a house in 2006, be careful, don't do those things. Don't get caught up in the frenzy, is I think the bigger warning for investors.
All right, Matt Weinschenk, with our educational segment of the week and a closer look at what is a stock market bubble. Our thanks to you. And if you would like to see much more content like this, including our special educational content with Matt, please subscribe to our YouTube channel. You can also find us on Facebook, Instagram, and Twitter. Thanks for watching. That's all for now.